Okay, what we're going to be doing here is reviewing the tax issues for the acquisition method here for business combinations. And this is going to include net operating loss carryovers, deferred tax assets, and deferred tax liabilities. First, I'll go through an example here showing the initial calculations here to determine the goodwill for these acquisitions. And then I'll go through examples here for calculating and recording net operating losses, deferred tax assets, and deferred tax liabilities. Here we'll go through an overview of the acquisition method here for business combinations. And for the example, Corp A will acquire or buy all of Corp B's net assets, that is, its assets and liabilities. And to demonstrate the basic accounting for this business acquisition here, I have set up Corp B's balance sheet showing its assets, its liabilities, and its shareholders' equity. Now, accounting for the acquisition method, that's based on the fair value of the assets and liabilities being acquired. Now, we must identify all the assets and liabilities involved and determine their fair value at the acquisition date. Now, looking at Corp B's balance sheet here, I have set up both the book value and the fair value of the assets and liabilities. Okay, to account for this acquisition, we're going to do a value analysis. Now, we're going to purchase these net assets at their fair value here, and we're going to exchange common stock for the net assets. So Corporation A here is going to issue common stock to Corporation B in exchange for the net assets of Corporation B. And our first scenario here will be the price paid here is greater than the fair value of the net assets received. So to determine our fair value of the net assets here, we've already determined that here by looking here at the $860,000 worth of our total assets here at the fair value, and then subtracting here the difference or our fair value here of our total liabilities of $140,000. So we have $720,000 of fair value for our net assets here. And because the price paid is greater than the fair value of the net assets received, there's goodwill involved. So to determine our goodwill here, we determine the price that we paid, that was the stock that we're issuing here for $800,000, and then subtracting the fair value of net assets that we're receiving from it for $720,000, we get goodwill here of $80,000. So here's our goodwill here, and that's its fair value here on our balance sheet. Okay, here we're going to be looking at the net operating loss carryover from the corporation that's being acquired. And in this case, Corporation B was being acquired by Corporation A, and Corporation B had an unused tax loss here of $200,000. So at the time of the acquisition here, we have to record a deferred tax asset here for this $200,000 net operating loss carry forward. But we have to set up here a contra-allowance account for any unused or unrealized tax asset here. And what I mean by that is we can only offset this net operating loss carry over here based on the income that we're producing. So if we don't produce enough income for Corporation A here, we cannot use the total amount here of the net operating loss carry forward. So for our example here, we had this $200 net operating loss carry forward, and then our tax rate here was estimated at 30%. So our potential savings here would be 30% times the $200,000 or $60,000. So in our example here, we're saying that we were unable to use $20,000 of that $60,000 because we're not going to be able to generate enough income to absorb all of that loss. So our net operating loss here would be $40,000. So going down here, looking at our balance sheet here, we have a deferred tax asset recorded here of $60,000 at the fair value here, and then we have a $20,000 unusable amount here, which would be an allowance account for this deferred tax asset. Okay, now let's calculate the goodwill here, which includes this deferred tax asset. So looking at our value analysis here, our fair value of our net assets, for our total assets here we have $900,000. That includes this deferred tax asset here of $60,000 less the unusable amount here of $20,000. And then for our total liabilities here, the fair value, that's $140,000. So the difference here, $140,000, subtract that from the $900,000, and we have $760,000 for the fair value of our net assets. Now looking at our price that we paid here, that was the $800,000 worth of stock that was issued here, and then subtracting or looking at the difference here of the fair value of our net assets of $760,000. So the difference between the two gives us a fair value of our goodwill here of $40,000, and that's what we have recorded here on the balance sheet, that goodwill for $40,000. Okay, to record this deferred tax asset, we'd set up this deferred tax asset account here and debit or increase it here for $60,000, and then we'd have this contra account here, deferred tax asset allowance account here. We'd credit it or increase it here for $20,000, and then we'd record our goodwill here for $40,000, or we'd debit or increase our goodwill here for $40,000. Okay, let's look at a non-taxable exchange here and determine our deferred tax assets and our deferred tax liabilities. Now, with a non-taxable exchange, that means that the book value will be used for taxation and the fair value will be used for financial reporting. And to determine our deferred tax assets and deferred tax liabilities here, we have set up a little chart here where we've got our accounts listed here, and then we list the fair value for each of those accounts and our accounts here, and then we list the book value for the accounts, and then we take the difference between the fair value and the book value here, and we list the difference here, and then we have to determine the deferred tax asset or the deferred tax liability. And what we'll just take here the tax rate that we have here, and we're using 30% times the difference between the fair value and the book value here, and that we would list here as a deferred tax asset or a deferred tax liability amount. Now, to determine if it's a deferred tax asset or a deferred tax liability, we have to go through our little chart here. So I've got it set up here as where the difference equals either a deferred tax asset or a deferred tax liability. So if the fair value of the asset is greater than the book value of the asset, comparing the two here, then it's a deferred tax liability, and if the fair value of the asset is less than the book value of the asset here, it would be deferred tax asset. And then for our liabilities, it would be the fair value of the liability. If it's greater than the book value of the liability, then we have a deferred tax asset here, and if the fair value of the liability is less than the book value of the liability, then we have a deferred tax liability. So what I've made that comparison here between the fair value and the book value, and whether it's greater than or less than the asset or the liability amount here, and then we determined here that in this case it was I've got it listed here in red here, deferred tax liabilities here, and then we had a few deferred tax assets here. And then the total amount here was we have to record, because that's what we're going to use here to determine our goodwill here. And our total amount here was a minus amount, or a deferred tax liability here, of $115,000. Okay, to calculate our goodwill here for this non-taxable exchange, we'll look at our value analysis here, and I have a deferred tax liability set up here as under the liabilities account. So our fair value of our net assets, that would be the $860,000 for our total assets, less the total liabilities here of $255,000, which includes this deferred tax liability here of $115,000. So our net assets here, a fair value of $605,000. And the price we paid here was $800,000 for the stock that we issued here, less the fair value of our net assets here of $605,000. So our goodwill here would be $195,000, and it's shown over here. Now, to record this on our balance sheet, we'd debit or increase our goodwill here for $195,000, and then we'd have this deferred tax liability account here for $115,000.